Knowing the tax code and knowing how to maneuver the tax code to benefit you is an extremely important issue, and it's one that must be addressed. Remember, every dollar you don't give the government back in retirement in the form of taxes is a dollar you get to keep and spend for you and your family. I think I might have mentioned many times that I'm a firm believer in that if you've worked hard through your entire life, if you've paid taxes for 50 years, you should be able to retire tax-free. Unfortunately, the government doesn't particularly care for my method. However, they have opened up a window for us to use to retire tax-free, or at the very least, tax efficiently. One of the things that we have been talked into years ago is that if we pay into our 401k, if we save for our own retirement, the government would do us a wonderful favor. They would defer taxes on any of our contributions. They would defer taxes on any of the accumulations in our portfolios. They would defer taxes on any of the company matches. And that when we retired, we would be in a lower tax bracket because we no longer have earned income. And then we could take distributions out with a tax-favored situation at hand because we no longer have earned income. Unfortunately, that is a half-truth. What we've noticed over the last, I'm going to go the last 20 years, but specifically over the last 10 years, is irresponsible government spending. We take in about $5 trillion a year in taxes, but they've decided that they're going to spend over $7 trillion. So what they've been doing is borrowing. And in addition to that, with interest rates going up, the interest on the debt is now over $1.1 trillion. In all probability, taxes will go up significantly, especially in these qualified accounts. Why? How could taxes go up, Phil? I don't understand. Doesn't everybody pay the same tax rate? Yes, they do, but everybody has a different size 401k or IRA. For many of you folks that have 7-digit 401ks, you're going to have to take out what's called a required minimum distribution. This is a major tax trap. The way RMDs work is they take the uniform life expectancy code. I know it's boring as all, but at 73, your first RMD is due if you were born before 1960, and at the age 75, your first RMD is due if you're born after 1960. They take the total value of your account on December 31st. Let's say it's 1 million, 1.5, whatever it happens to be. They take your life expectancy. At 73, they say your life expectancy is about 26.5 years. They multiply the life expectancy into the ending balance, and now you must take that RMD. So for many folks, they're starting out with a required minimum distribution of $50,000, $40,000, $60,000. Now, each year what happens, you get 1 year older. So you have one less year in your life expectancy. And your IRA, if it's managed properly, especially if it's managed actively, your IRA balance is going up. So what we're seeing with clients is their first RMD might be 50, then the next year it's 55, then the following year it's 60, then it's 80. Then it's 90. When you get into the 80s, these RMDs go up over $100,000. If you're married, you're escaping some of the volatility with being forced to take more money out of these retirement accounts. However, at the death of the first spouse, you go from married filing joint to now filing as a single. Your tax bracket doubles and your surviving spouse is also now left with these monster required minimum distributions. Taxes can double and in some cases triple. Now here's the solution, folks. What you need to do before your first RMD is start executing Roth IRA conversions. You see, in 2010, the federal government, they all agreed on allowing individuals to take money from an IRA, pay taxes on it once, move it over to a tax-free IRA, and then allow that tax-free IRA to grow and grow and grow tax-free. It accomplishes these objectives. Number one, the more money you take out of your IRA, and it must be done strategically, significantly reduces your required minimum distributions once you reach age 73. Or 75, depending on when your first RMD is due. What we have done for our clients is we have each year strategically done mock tax returns. This allows you to understand how much you can convert from your taxable government retirement account to your own tax-free Roth account each year at the lowest tax bracket. If your current advisor is not talking to you about executing Roth conversions, chances are you're going to end up in your latter years with a major tax trap. The federal government will become the primary beneficiary of your IRA because of the RMD situation and because of the increasing debt. Once you establish a Roth IRA and that account has been active, whether you have $1 in it or whether you have $1 million in it, you have what's called a 5-year clock. Once you put money into the Roth IRA, you can now take a distribution tax-free if you're 59 and a half or older. However, you cannot empty the Roth for 5 years. You cannot withdraw all of the contribution or conversions and the earnings. You can only take out the contribution. So let's go ahead and discuss this. What are the benefits? Well, first of all, a Roth IRA has zero tax effect on your Social Security benefits. Let's assume for a moment you maximized your Social Security, and like many of us, you've worked your tail off over the last 30, 40, 50 years and paid the max into or close to the max Social Security. Of course, your financial advisor has done a Social Security maximization report. Let's say you're pulling $60,000 or $70,000 a year from Social Security. By taking distributions from your Roth, this causes your Social Security to put you in a 0% tax bracket, meaning I have clients that want to retire with $120,000 a year after taxes. They'll pull $70,000, $75,000 from Social Security. They'll pull another $70,000, $75,000 from their Roth. They're now pulling $120,000 to $150,000 in retirement income. None of their retirement is taxable. Zero. Once we take a distribution and we've left it in there for a 5-year period, we can take as many distributions as we want tax-free. If we're coupling a Roth distribution plan with Social Security, you're taking money from your Roth and Social Security, none of your Social Security is taxable. However, let's take the same situation. You still maxed out your Social Security. You have 70 or so thousand coming from Social Security each year, but you take another 60, 70, or 80,000 from a traditional IRA. Not only do you have to pay the tax on all the distribution from the IRA or 401k, but it causes 85% of your Social Security to now be taxable. Knowing the tax code and knowing how to maneuver the tax code to benefit you is an extremely important issue, and it's one that must be addressed. Remember, every dollar you don't give the government back in retirement in the form of taxes is a dollar you get to keep and spend for you and your family. Let's talk about RMDs. Folks, if you have a very modest retirement account, maybe you have $100,000, $200,000 in it, and you're getting ready to retire within the next 4 or 5 years, there probably won't be a negative tax consequences to RMDs because your required minimum distributions will be significantly low. However, if you have a retirement account of $500,000, $1 million, $1.5, $2 million, this is going to, in all probability, cause a serious tax effect. Again, once you turn either 73 or 75, based on when you were born, whether you were born before 1960 or after 1960, your first RMD will be relatively small because you have a longer life expectancy. But once you get into your latter years, your RMDs will jump. There are 2 ways to get around the RMD debacle, let's say. Number one, if you're charitably inclined, you are allowed to do what's called a QCD, Qualified Charitable Distribution. That's what a QCD is. For instance, let's assume that you have, I don't know, the National Dogs Association of America or Cats Association, and they are a legitimate 501c3 charity. As long as they have a tax number, an EIN number, you can have your RMD paid directly to the charity as opposed to having paid directly to you. Now that is totally tax-free. The rest of the IRA will convert over to the Roth so you can take tax-free distributions from the Roth. Remember, folks, we have to pay taxes on any distribution. The government has opened the window since 2010 to allow us to execute Roth conversions. There's no age limit, no limit on the amount you can convert each year. Remember this, though, you are not allowed to take an RMD and convert that to a Roth. So for you folks who are in your 70s or even 80s, and you say, oh gosh, this is too late for me to execute a Roth conversion, absolutely not true. You still are allowed to do Roth conversions. You simply are not allowed to convert your required minimum distribution to the Roth. So for many of our clients that aren't really spending the RMD, we'll take that RMD and we'll use that RMD to pay taxes on an additional Roth conversion. The idea is each year you want that retirement account to drop significantly so your RMDs become lower and lower and lower. I started working when I was 15, my very first check. I got my check, and I could still remember I made just a little over $1 something an hour. I worked about 40 hours, and I'm expecting to get a $60 paycheck, and I get a check for like $41.70 some. I go to my manager, Bill, I said, I don't understand this. I was expecting to have a large, he goes, I'll flip it over. So we had state income tax, federal income tax, Social Security tax, Medicare tax. There were so many different taxes. He said, well, welcome to becoming a tax-paying citizen. Here we are 50 years later. If you want to continue to pay taxes until the day you die and then pass that tax burden off to your surviving wife or children, don't bother doing Roth conversions, especially if you have significant savings in your 401k. However, if you're sick and tired of paying taxes and you believe you've paid your fair share, then you want to execute Roth conversions. The government has given us a wonderful opportunity. They've allowed us to take money out of this taxable account, pay the tax once on the seed, put it into a tax-free Roth IRA, allow it to accumulate for my lifetime, my wife's lifetime, and up to 10 years of my beneficiary's lifetime, all tax-free. And by the way, folks, if you're still working, switch those 401k accounts. You can now contribute to the Roth 401k. In my professional opinion, I believe that once somebody hits 75 and they've paid taxes for 50 years or more, they have the right to retire tax-free. They've done their fair share. The IRS and our federal government has given us the law to allow us to retire tax-free. You need to have the knowledge to be able to execute to tax-free conversion retirement income plan. If you leave that money into your taxable 401k or IRA, all of the earnings, all of the growth, all of the market growth that you have, you'll continue to pay taxes on any distribution. I take $20,000 out of an IRA. I'm in a 20% tax bracket. I have to give the federal government $4,000. I only get $16,000 to spend. If I take $20,000 out of my Roth IRA, I give the government $0 because I paid the tax once when I put it in there. Years ago, taxes were as high as 75%. In some states, up to 90% for top earners. If the continuing increasing and spending of our debt continues, what's going to happen is taxes will have to go up or the country will default. Me, I like to err on the side of caution. I don't want to give any more money back for the government. So you be the judge. Do you want to take a distribution of $20,000 from your IRA and give the government $4,000 or $5,000 of that? Or do you want to take a $20,000 distribution from a Roth IRA, keep it all, and give the government nothing? The choice is yours. Here's an example. The client doesn't have a pension. They simply have Social Security and they have their IRA, their 401k. Client A, case study number 1. This client has not done any tax planning before they executed their Social Security withdrawal strategy or their IRA withdrawal strategy. So, client number 1, I'm going to collect my Social Security at age 62, 63 because I believe the government is going broke and Social Security will end. They file at 62. Now, Social Security will give them 75 cents on the dollar. Now, half of that Social Security goes into what's called a provisional income formula. And I won't get into the weeds with it, but what happens is the lower your Social Security is, forces you to take a larger distribution from the IRA. In 95 plus cases out of 100, 85% of that Social Security benefit is taxable. All of the IRA dollars are taxable. Thousands and thousands of dollars back to the government, not just on your Social Security, but also for the IRA. Case study number 2. This is an individual that understands they were a high wage earner. They've paid into Social Security. They have 35 top years of paying into Social Security. If they maximize their Social Security or file at full retirement age, they're going to get 100% of what they paid into Social Security. If they delay and wait till 70, they're going to get 132% of what they paid into Social Security. None of the dollars in the Roth go into the provisional income formula. Half of the dollars from the Social Security go into the provisional income formula. 0 taxes on Social Security, 0 taxes on their Roth withdrawal. Why? They did the heavy lifting before their first RMD. They started to execute Roth conversions, and then they also executed a Social Security maximization strategy. The two go hand in hand. You know, my dad used to tell me a story. He used to say, Phil, it's really important that you become an accountant. Every single year you're going to pay taxes. What happens is they close a door, but they leave a window open. Be a CPA, be an accountant, so you know the tax code. Maximize your Social Security, execute a Roth conversion, and you will retire tax efficiently. And in most cases, you'll retire tax-free. It's your wealth. It's our knowledge. Education will set you free. Give us a call. I'll see you in the office.